What's going on, everybody? This is the second part of the three-part series we have on how there's three main factors that affect the price of an option contract. The first one we did is on theta. If you want to check that out, go ahead and find it on the YouTube channel. It should be in this series as well. The second one we're going to talk about today is actually delta and how it affects the increase or decrease of the value of an option contract based off a dollar move in the stock price. So sit back, relax, and enjoy the video. Alright, so first things first, delta is the measure of the sensitivity of an option price as it changes the price of the underlying asset. For my new guys out there, you might be asking, what on earth do you even mean? Well, if we go to Tastyworks, alright, we're going to use the same example we had earlier for the theta option, and that's going to be the Walmart 18 days to expiration 140 call. So if I click on play right here, we're going to see a delta value of $54.69. What that means is every time this stock moves up $1 in value at this current time in play, the value of the contract increases by $54.69. Right now it's worth $242. So in the next few minutes, if it were to move up to $141.62, the value of this particular contract would be worth 54 plus 242, that's a little bit under $300. I think it's like a 20% return, roughly 20, maybe 22%. But anyway, you can see just by seeing the stock itself move up $1 in value, you can see an increase in delta, giving yourself a nice return on that option. So what we're going to do here, we're actually going to go down to the 139 call and show you just like that. It actually kind of like a good little representation, just how seeing the stock move up $1 in value, because remember on theta, every strike that this contract moves away from our little actual price of the stock right here, little circle, that's a good representation of saying it's the same thing as seeing the stock go up $1 in value. So we're going to go from the 140 to 139, and we're going to see that this contract is actually worth $305. But there's a caveat to this, guys. You got to be very particular on your timing on this, because what happens if it moves away from the contract or closer to the contract? What I mean by that is if you have an in the money call, which means it's behind the actual price of the stock, and it goes under and it's out the money, so say this is the same as saying the price dropped $1, now you actually lost money on this. You lost roughly $50 on this trade because the delta value itself, remember, delta works both ways. If it goes up in value, you gain value on the option contract. If it goes down in value, you lose value on the option contract. So be careful with the data, be careful with the delta value that you use, because that will also affect your stop losses. And just you might see the stock move down $1, then ricochet back up. But because it moved down $1, you might have been stopped out or panicked because you're down 20% on your position, when in fact, if you would have held out, you probably would have seen a 40, 50, 60% return because your technical analysis was solid, because you also checked out our technical analysis videos that we have, and you became a better trader and gave yourself a trading edge that way. But guys, if you are a little sensitive to delta and you're like, I don't want to see $54 shifts in the stock price, there's another option we can do. We can go to vertical. We can do a long call, which is where we buy a call and sell a call. And if you see here, you can kind of play around with these numbers. But now your delta decreases significantly. What that means is as it increases in value, you only gain $15 on the value of the contracts. But if it goes down in value, you're going to lose around $15. So that helps out our newer guys when they want to manage risk and manage their position. However, if you want to be a little more reckless, and if you're a little more short-term as a trader, you can go ahead and do the first option, which is buying those naked calls and seeing these crazy returns if you're right on the direction. And if you want to be right on the direction, click that link in the description below. It'll take you to TradeUI, where you can access their site that has various option tools that give yourself a trading edge. We have tons of videos on their content and how you can utilize it to give yourself an edge. And if you enjoyed this video, go ahead and give it a like, subscribe, leave some comments for us so we know how to make this channel better. Guys, I really do hope you enjoyed this video. At the end of the day, we want to make y'all better traders, and one video at a time, we will all become better. We're going to end it here. All right.